I am Director of Research of a small boutique company based in Cambridge that tracks portfolio capital flows in pretty much all fund groups and across all markets. 10 years ago it was called hot money. Now it tends to just be called portfolio capital. At the moment we track somewhere around 45,000 funds with a little over 17.5 trillion in assets under management, of which money market funds are probably the biggest single group, followed by bond funds.
So how much capital is actually investing into Africa from other parts of the world?
A fairly small slice of that impressive sounding headline figure. The story that we've been seeing with regards to emerging markets and Africa is, again, a transitional one. On the equity side, over the past 18 months, we've seen a real capitulation on the part of retail investors with regard to emerging markets equities. They've really more and more taken the opportunity every time the markets go up to exit. And what this has done is create entry points for institutional investors, which they have been taking. So there hasn't been a huge increase in the stock of foreign capital going into Africa, but the ownership of that capital, there's been a noticeable shift towards the institutional. And one small measure of that is we're seeing greatly reduced reactions to the kind of headline events that usually send retail investors running. The recent violence in the South African mine pay disputes had a very modest effect on flows into South Africa equity funds, whereas in 2 years ago it would have probably sent them spiking way down. So there's been sort of for want of a toughening of the people who are steering foreign capital into Africa.
So what's the number?
Well, actually, the number isn't too bad this year. It's close to 2 billion channeled through bond funds into African fixed income, and around 800 million into African equities. The caveat to those figures is that it's almost all been South Africa until very, very recently. Part of the shift towards a more institutional pattern of flows has been this question of fiduciary duty, which they have tended to try and meet by channeling the money through diversified funds, be they Africa regional or the big global emerging markets funds. And what that tends to do is put a heavy premium on the safest, biggest, most recognized market, which is obviously South Africa.
And we chatted about this a little earlier, the flows into sovereign debt that you're seeing for institutional investors is direct or indirect?
It's pretty indirect. And this we are hearing anecdotally, I cannot really confirm this, that because of the much tougher regulatory climate that has sprung up in the wake of the financial crisis that started in 2007, 2008, and because of the huge funding needs that crisis has created in the traditional pools of capital, which is the US and Europe, we're definitely hearing it's a bit harder for many pension fund managers to steer money overseas when there's so many claims on its use in their home markets.
Doing business in Africa, you can't afford to be without Africa Investor.